Well, hello there. We're going to take a look at the summary of economic projections from June, talk about what we could possibly see tomorrow from the Fed and how it could impact the markets, including a technical analysis view of SPY, QQQ, and IWM. I woke up with a serious case of morning voice this morning. I thought that I would use it to my advantage. In the beginning of the video, what the heck, something fresh, something new, the summary of economic projections from June. This is the one that we got back in June. We get another one quarterly, which means this September meeting is when we see that next one come out. And this is one where the Fed discusses what they see coming up potentially for GDP, unemployment, and inflation, and the all-important federal funds rate. So we're going to talk about the impacts that we could see from this. First and foremost is the GDP. From the last estimate that we got, we saw that rocking at about 3%, mostly consumer-led, which considering that 70% of GDP from the US is made up by the consumer, that is a very strong signal for that. That really helps out the Goldilocks scenario. So depending on what we see coming out from the Fed for the end of 2024 could be impactful, especially if it's down below that 3% mark. The more heavily it's down below that, the more that we could see that impact the market and be negative pressure on that. The closer we are to that, the better. If we come in above that number, that's even better yet. But I think it's either going to be even or below to the expectation that the market has right now based on the most recent GDP estimate. So keep an eye on GDP for that reason. Unemployment rate, the last we saw was 4.2. So I can imagine that this is probably going to come in higher for that unemployment rate. Now, mind you, if they see the year ending higher, and now they don't give a single number, what they do is they give a range of numbers that you see over here. So we can actually watch that range to see how that's being adjusted. And then what you see from that is the median estimate. So the middle number by position, when you order the numbers from least to greatest, that's the numbers that you see. So if that median shifts up on us, or if we get the low and the high end shifting up on us drastically for unemployment rate, especially if it takes us well above that 4.2, that could be downward pressure for the markets because we have just a few numbers to get out between now and the end of the year. So we just got August numbers, so we have September numbers coming up at the beginning of October, and then the beginning of each month after that for the recent month that has just passed by. So we won't actually get December's numbers until January when it rolls around. For that unemployment rate, it's usually that first Friday that we get for the month. So we want to watch and see what they say for unemployment rate. If this is a number that they kind of keep pretty steady for us, that's going to be a good thing. It will move up, I believe, probably up to that 4.2 that we saw the last time. If they show us 4.4, 4.5, something wildly higher, that can be downward pressure for the markets. I do think that the Fed is going to be very careful not to put anything out that's going to signal recessionary pressures. Now, mind you, that thought could be wrong. If they go out and they say that GDP they expect to be softer to end the year and even softer in 2025, or if it's something for the unemployment rate that they see a spike coming our way in 2024, 2025, those would be recessionary signals, recessionary pressures. The market probably wouldn't take too kindly to it, especially where IWM is concerned, even though no index, I believe the S&P or the NASDAQ 100 would be safe from that. IWM, I don't know if I mentioned it, Russell 2000's stocks is what that ETF tracks. So back over to this report, inflation, we want to watch this to continue to moderate. We want to see that come back down towards that 2% target. So if they see that continuing to decline, that can be upward pressure for the markets. Staying steady, rising would be worse. So as long as we don't see that rise, I think we're okay. And you can see from the March projection to what we got in June, so over that 3-month course, we've moved up a little bit since that time. On a core basis for PCE, you can see that as well, that we are down below that 3% mark, down in the 2% range. They said that they wouldn't wait for 2% to start cutting, so we do expect to see anywhere from a 25 to 50 basis point cut. I think the summary of economic projections is the bigger of the two catalysts that we need to pay attention to. So 25 it will be good. Now, mind you, that risks the fact that the Fed could be even further behind. So if that's the narrative that they run with, that could be downward pressure for the markets if they do a 25 basis point cut. If they do the 50, it can be like, why are you guys trying to go so fast on this? So we want to be careful with that. We want to watch for that. It really is nuanced with the rest of the information that we get. Now, if they do a 50 basis point cut
and they're putting out strong GDP numbers, low unemployment numbers, low inflation numbers, that would really be a strong case for a Goldilocks scenario, especially as it bleeds into 2025. So a scenario like that where we see strong economy and then we don't see that rapid rise in unemployment, when we also see that low inflation going along with it, that would make the Russell 2000 stocks really rally along with the rest of the market. I think would do very well off that. And the market's actually doing pretty well this morning. We'll talk about that right after we get to the federal funds rate. So we want to watch these targets and the expectations, because what we want to see is that the cuts aren't necessarily getting too aggressive. If they do happen to lower from the 5.1 for end of 2024, 4.1 for end of 2025, 3.1 for end of 2026, and a longer run rate of 2.8%, you'll notice that that's up a little bit from what it was from March into June. So for September, when we look at the federal funds rate, we want to see that number start to pull back on us just a little bit, though, not too aggressively. That could be bullish for the markets. If we see too much in the line with too aggressive of cutting, that could signal that the Fed is behind the 8 ball. Now they're trying to play catch up. So that's something we want to pay attention to. Being one cut off, not too bad. One cut being the 25 basis point that I'm referring to. If it's more than that, could be a bit worse. So we don't really want to see massive, rapid changes to this because, like I said, that could be downward pressure for the markets. But remember, none of this happens in a vacuum. It doesn't happen in isolation. It happens all together, and it's nuanced, and these are my thoughts that I have on this. So what do we want to see for a bullish market? High GDP, low unemployment, low inflation, and the federal funds rate. We would like to see this number come down quickly, but without alarm, if that's a nice way to say that. Anything where we get GDP starting to push down, starting to really lower significantly. Now, mind you, I think it should already come in at around 3% given our last GDP estimate that we got. The next one isn't due out until a little over a week. I think it's September the 26th. We want to be watchful for that. Unemployment rate, we don't get that next number until beginning of October. And then PCE, we should get that at the end of this month as well. I think that's probably the 27th. It's usually the last Friday of the month. So we want to be watchful for that. So for downward pressure for the markets, lower GDP, higher unemployment, especially getting into 2025 for these, anything that really starts to signal recession. And if we do get that recession, then these values could actually start to go into deflation mode, which we would actually see those negatives. So if we see these drop drastically as well, that could also be a recessionary signal. So let me switch over to the charts from there. So I'll put up a trading view and we'll start talking about what we can see happening in the pre-markets. And let me go. There we go. We got that up for you. And I got to bring that down and put this up. There you go. Now you get more than just my pretty face on this. So SPY actually broke up above its top trend line. I said, watch for a rejection. We never actually got rejected there in the pre-market hours. Let me make this bigger for you so you can see. In the pre-market hours, we're actually dancing above that trend line. So this is a decent start. Now, mind you, we'd have to hold on to that. That does break the previous peak that we saw back here going all the way back to the end of August. However, it doesn't yet break the peak that we had going back here all the way to this day in the after hours. This was July the 16th was the peak of the S&P. So we haven't gotten there yet. And then what we want to look for, if we are going to hang around up here, we want to watch for a rejection, not necessarily off that trend line. The next rejection that we want to look for is actually up here off of this trend line that I have, because this marks the most recent all-time high that we've had. So we want to watch for that with some resistance up above. If we're able to get up above that, if we get really good news from the Fed leading into the end of the year, because don't forget, we still have the election coming up. There's a lot of uncertainty that follows. Expect any amount of volatility. That really starts to open up our eyes to getting into the high 570s, and then up above there, there could be room to the upside for more, but we do run into more resistance lines up there. It starts to get a bit choppy. So just in the near term, leading up to the Fed meeting, we want to watch out for what can happen here. We're not high enough up here that we can't necessarily reverse course. We do want to watch rejection off that all-time high price. Even if that is only an intraday value, it's still something that we could most definitely see a smacking of our heads off of that line, retracing back down. Maybe that's when we catch this trend line, which is off the previous peaks. We're really going to have to see. Moving into the Qs from there, we actually broke through the bottom of the top trend lines that I have on here, and it depends on if we're looking at daily chart, which does not include extended hours, or if we're looking at extended hours trading. but you can see I said about watching for the rejection. You can actually see it happening back here, and you can see it happening again in the pre-market hours this morning, potentially up to a double top. We're going to have to watch and see. That would be a near-term thing, but again, I think that this is far less significant, especially being in the pre-market hours for what's happening right now, and we will switch this if we can stay above this. If we can close above this line, we can switch it from from resistance over to support. We want to be watchful for that. Breaking above this trend line gets us room up to about 479 to 480. So we want to be watchful for that. If we get rejected, we do have some temporary support off these trend lines and what we see right here. And then going all the way down, that's about 474 down to about 472 below that. And like I said, I think today, I don't know that today's that really big day. We could get some trading. We could get some money taken off the table leading up to the Fed meeting. But we're going to have to watch and see what happens. I think the big moment is tomorrow at 2 p.m. and then again at 2:30 p.m. When Jerome Powell comes out and speaks. I think that those are the major catalysts that we're waiting for. Speaking of catalysts, look at IWM. I said most likely we would stay inside this range from 216 to 218. And yesterday, we pretty much did stay in between there. And I think the Russell 2000 stocks, IWM is the ETF that tracks them. I think we really are waiting to find out from the Fed what they see happening. Goldilocks, I think we start to go through and start smashing through these resistances that we have to the upside. If we see more recessionary signs from that, then it's that downward trajectory that we could be on. I don't know if you guys can hear my my nearly 15-month-old daughter. This Thursday, she'll be turning 15 months, and she's a very big joy to have in the house, along with the teenage daughters, who one of which, when she does turn 15 months old, the other one's going to be 12 times her age because she's 15, the other one's 13. And being a girl dad certainly has its frustrations, but even more so than that is the blessings that come along with it. I'm very, very pleased. If you guys like this analysis, by the way, and you want to see more of what I have to offer, such as the technicals before they hit YouTube, there is a link for the Discord down in the description. It's the Patreon link. Join the Discord through that when you sign up, and then you can also see my buys and sells. You can talk to me and my community members, and then there's also a link for technical analysis trading through Stockmo Academy. You can click on that and sign up for that course, get access to the bread recipe, learn all about it. It's a trading strategy. Very easy to set up, very simple to set up and follow, and gives you very clear signals when a stock could potentially skyrocket or could potentially fall through the floor, and you can play it in either direction. I have a chapter in there on options that you can also check out as well. Use the code word doctor when you do sign up, DOCTOR. That's going to give you a massive discount on that course. And the trading strategy is very powerful. A lot of people putting out testimonials that they're paying for that course, the price of the course, in as little as one single trade using that bread recipe. Guys, thank you very much for watching. I really do appreciate it. I am Dr. Stock, Doctor of Education. Remember, my friends, that learning is earning, and we'll see you in the next video.